Okay, this is that Feld, his last name was Feld, Brad Feld, handout on basically a term sheet. So anyway, I'm going to go through just parts of this. I sent you out some of the definitions earlier, or I did some definitions on some of the other videos. Okay, so these are just important points. In general, there are only two things that venture funds really care about when doing investments: the economics of the investment and the control they have. The term economics refers to the end of the day return that the investor will get and the terms that they have direct impact on such a return. The term control refers to the mechanisms which allows the investor to either affirmatively exercise control over the business or allow the investor to veto certain decisions the company can make. Okay, so this talks about obviously the first term an entrepreneur is going to look at the price. The pre-money and post-money terms are pretty easy to understand. The pre-money valuation is what the investor is valuing the company at today, okay, before the investment, while the post-money is simply adding the post-money amount to the pre-money, right? There are two items to note within the valuation context: stock option pools and warrants. And I've sent you definitions on those, but just remember, stock option is basically it's sold or given to a party from one party to another. In this case, it'd be the company. It gives the owner of that option the right, but not the obligation to buy a stock at an agreed upon price within a certain period or specified date. Okay. Really, a stock option is a little bit different than that. A stock warrant is really what you think of as a stock option in this case. I don't know why they use the term option, but they always do instead of warrant. A stock warrant is just like a stock option because it gives you the right to purchase a company stock at a specific price and at a specific date. However, a stock warrant differs from an option in two key ways. A stock warrant is issued by the company itself, which would be in this case. That's why I think these are warrants, not options. And the new shares are issued by the company for the transaction, which it is in this case. Stock options really have to do with options that are sold on the market, where one person owns a stock and they give the other person the option to buy it at a certain price for a certain period of time. So the correct term to me has always been stock warrant. I don't know why all these books use the term stock option, but just keep in mind what you think as an option is really a warrant. So when you think about a warrant, think about a stock option. It's the same thing basically. Okay, then it goes down farther. Talks about recently another term has gained popularity among investors as warrant. So this talks about how an option is, basically both the company and the investor will want to make sure the company has sufficiently reserved shares of equity to compensate and motivate its workforce. The bigger the pool, the better, right? Well, not so fast. With a large option pool, it'll make it less likely that the company runs out of available options. They got to take into account the size of that pool when they do the valuation of the company, which therefore lowers the pre-money valuation. An investor is going to want those stock options included in the pre-money valuation so it doesn't dilute the investor's investment, right? We kind of talked about that before. Now they talk about warrants. And as with stock options allocation, this is another way to backdoor a lower valuation of the company. Warrants, as part of a venture financing, especially in early stage, tend to create a lot of unnecessary complexity and accounting headaches. If the issue is simply one of price, we recommend an entrepreneur negotiate a lower pre-money valuation to eliminate warrants. So I guess there is a technical difference. I'm not sure what the difference is, to be honest with you. Okay, the warrant value, though, is rarely calculated as part of the valuation where the options are. So there's a difference. I guess there is some type of difference. I'm not clear what the difference is. Okay, the best way for an entrepreneur to negotiate price with his valuation is to negotiate with multiple VCs, which will bid up the price, right? Okay, then there's these term sheets. Liquidation preference, we've gone over that, with a couple videos, and there's actually sample problems on that. That just has to do with the order in which you get paid And if you're like a preferred stockholder, they're talking about stocks in this case. They're not talking about debt, but basically debt gets paid first, preferred stock gets paid second, and common stock gets paid third. When they talk about liquidation preference, then preferred stock will get paid before common stock, and then typically just 1 times the investment amount, and then they get the remaining percent of whatever money's left from the liquidation. They get what percent ownership they had. And when you say 1 time the money amount, it's the amount the debt or the amount they invested plus any accrued or deferred interest. And typically it's 1 times that. Now, when we get into the other preferential, whatever it is, we'll get on that next page. It takes into account something different. But anyway, so that's the liquidation preference is on a term sheet. These are all things that are on term sheets. Board of directors is on a term sheet. And basically, VCs are going to want to control some type of control. So there's going a place where you say how many board directors there will be on the board and who actually gets to appoint them. If the investor gets to appoint 2 and the founder is 3, then the founders are going to have effective control, right? So it not only says how many, but who gets to appoint them. And then many investors will mandate that one of the common stock chosen board members be the then serving CEO of the company. Okay, I'm just going through some points. I'm not going to read this whole thing. Protective provisions on a term sheet. Protective provisions are effectively veto rights, and what they do is they keep the founders from doing certain things like issuing more stock, which dilutes the VC stock, different things like that. So those are some type of protective provisions where they have veto rights over certain things. There's a whole list of these things. I sent you a definition on this. Drag along, this would be on the term sheet. Drag along agreement. The holders of common stock or founders and Series A preferred shall enter into a drag along agreement. This is if they have a drag along agreement, whereby if the majority of the holders of Series A preferred agree to sale or liquidation of the company, the holders of the remaining Series A preferred and common stock shall consent and raise no objections. So they're dragging along with that liquidation or sale, right? That's why it's called drag along. There's also tag along. They don't show that in here, but tag along is more favorable, where basically you go along with them. There's some type of provision for that. I sent you that definition. Anti-dilution. This is another protective provision. Basically, anti-dilution provision is used to protect investors in the event the company issues equity at a lower valuation. Then you don't have to know these, there's 2 varieties, weighted average anti-dilution and ratcheted base anti-dilution. And basically it prevents the current owners from being diluted, or the VCs in that. Okay, and then we're going through this some more. Term pay to play. I sent you this definition. In term sheets, we're down to the last one, pay to play provision. Basically, in pay to play, an investor must keep paying, participating proratably, but ratedly, just think of the same thing, in future financings in order to keep playing, not having his preferred stock converted to common. So that's just some type of provision. You got to keep paying off so your preferred stock isn't converted to common stock. Term sheet about dividends, it'll take into account what the dividends are. Term sheet about redemption rights, and it just basically says redemption at option of investors at the election of the holders, or at least a majority of the Series A preferred. The company shall redeem the outstanding Series A. That means they'll buy it back, right, in 3 annual installments. So there could be a redemption clause. Usually that's with bonds too, and remember, these are preferred stocks. Conversion. This is all part of a term sheet. Conversion. The holders of Series A shall have the right to convert Series A at any time into shares of common stock. So that's a conversion clause. Sometimes it's at 1-to-1, typically. Conditions precedent to financing. I don't know what that is. Vesting. Basically, vesting just talks about if you have options and say you have to, for those options, for you to be able to gain those options in that pool, you have to be there for 3 or 4 years. Vesting typically has, in this case, they're talking about with options or something like that. Also, if you've been there for a while, your retirement invests too. But in this case, they're talking about investing. So typically involves options. You've got to be there for a certain period of time to get investing so that you get those options. Information and registration rights. Information rights are just basically saying that because you own Series A or common stock, you get certain information like audited annual and unaudited quarterly returns. Just those are your information rights since you're an owner. Registration rights, I have no idea what that is, and it says it takes more than one sheet, so I'm not going to even pay attention to that. It's just important to know what some of these are, not the more complicated ones, and to know that they would be on a term sheet typically. Right of first refusal typically means when you're selling something, the VCs or the company might have a right of first refusal on it. I'm not exactly sure what it is in this case. I didn't see it on the definitions that he had flagged as something. Term sheet voting rights and employee pool. Voting rights basically it talks about, Series A will vote together with common stock. Sometimes the Series A, sometimes these won't have voting rights because they have the liquidation preferences. Sometimes they won't have voting rights, but that just talks about their voting rights and the employee pool. This talks about the reserve shares of common stock so that blank percentage is fully diluted capital stock with the issuance is Series A is preferable. About. This talks about the employee options pool. Term sheet restriction on sales, proprietary inventions, and co-sale agreement. I wouldn't worry too much about that stuff. Founders' activities on term sheet. Initial public offering purchase on the term sheet. No shop agreement. Not sure what that means, but usually it has to do with shopping future financing to outside VCs or something. Unilateral or serial monogamy, that has to do with marriage. No, I don't know what that's about at all. Indemnification and assignment, don't worry about that. That's too complicated to be on here. So basically, that's looking at a typical term sheet. Remember, these term sheets are just used as a basis to structure the legal documents. So these are not legally binding. They're just used as a basis to prepare the legal documents. It's a shorter way of getting all that information hashed out in negotiation so that the legal documents can be prepared. And that's it. Business 436, Brad Feld's term sheet document.